picking up again. We have a new... Heads up. Here we go.
Hi everyone, welcome to the National Press Theatre. We are joined by Governor of the Bank of Canada, Mark Carney, and Senior Deputy Governor of the Bank of Canada, Tiff Macklem. They will do a presentation and then we'll take questions. Please raise your hand if you have a question. I will write you down on my list. Turn off your cell phones first. Thank you. Go ahead.
Okay, thank you very much, Marie. Good morning, everyone. Tiff and I are very pleased to be here this morning to discuss the October Monetary Policy Report of the Bank, which was released this morning. L'évolution de l'économie mondiale a été largement conforme aux projections de la Banque énoncées dans la RPM de juillet. La croissance a ralenti dans l'ensemble des principales régions. L'économie américaine croît à un rythme graduel. L'Europe est en récession. Les indicateurs récents donnent à penser que la contraction là se poursuit. En Chine et dans les autres pays émergents, la croissance a décéléré un peu plus que prévu. On observe toutefois des signes de stabilisation autour de taux d'expansion actuels. Malgré le ralentissement de l'activité à l'échelle du globe, les cours de pétrole et d'autres matières premières produites par le Canada ont augmenté en moyenne ces derniers mois. La conjoncture financière mondiale s'est améliorée sous l'effet des mesures politiques énergiques prises par les grandes banques centrales. Cependant, le climat demeure fragile. In Canada, while global headwinds continue to restrain economic activity, domestic factors are supporting a moderate expansion. Following the recent period of below-potential growth, the economy is expected to pick up and return to full capacity by the end of 2013. The bank continues to project that the expansion will be driven mainly by growth in consumption and business investment, reflecting in part very stimulative domestic financial conditions. Housing activity is expected to decline from historically high levels. The household debt burden is expected to rise further before stabilizing by the end of the projection horizon. Now, there are upside and downside risks around the evolution of household imbalances. Residential investment could regain momentum, thereby reinforcing existing imbalances. Conversely, continuing high household debt levels could lead to a sharper than expected deceleration in household spending. In this context, Canadian authorities are cooperating closely to monitor the financial situation of the household sector and are responding appropriately. Canadian exports are projected to pick up gradually, but remain below their pre-recession peak until the first half of 2014. This reflects weak foreign demand and ongoing competitiveness challenges. These challenges include the persistent strength of the Canadian dollar, which is being influenced by safe haven flows and spillovers from global monetary policy. After taking into account revisions to the national accounts, the bank now projects that the economy will grow by 2.2% in 2012, and going forward we expect growth of 2.3% in 2013 and 2.4% in 2014. Core inflation has been lower than expected in recent months, and this reflects somewhat softer prices across a wide range of goods and services. Core inflation is expected to increase gradually over coming quarters, reaching 2% by the middle of next year, as the economy gradually absorbs the current small degree of slack. The growth of labor compensation remains moderate, and inflation expectations remain well anchored. Total CPI inflation has fallen noticeably below 2% target as expected. It's projected to return to target by the end of 2013, somewhat later than previously anticipated. Des risques importants pèsent sur la perspective d'évolution de l'inflation au Canada. Dans sa projection, la Banque suppose que les autorités en Europe sont en mesure de contenir la crise actuelle. Elle suppose aussi que le précipice budgétaire aux États-Unis sera évité. Il y a trois principaux risques à la hausse et trois à la baisse qui sont détaillés dans le rapport. Overall, the bank judges that the risks to Canada's inflation outlook are roughly balanced over the projection period. And reflecting all of these factors, the bank yesterday maintained the target for the overnight rate at 1%. Over time, some modest withdrawal of monetary policy stimulus will likely be required, consistent with achieving the 2% inflation target. The timing and degree of any such withdrawal will be weighed carefully against global and domestic developments, including the evolution of imbalances in the household sector. And with that, Tiff and I would be pleased to take any questions. Thank you.
First question is from Nirmala Menon, Dow Jones.
Governor, I'm wondering about the statement yesterday, the rate statement. You said you included the fact that household imbalances would be a factor in consideration for future rates, for potential rate hikes. How much of that is because the finance minister said he's not looking at any more measures, at least in the foreseeable future, and how much is that from changes to the StatsCan data that showed the debt levels are even higher than previously estimated?
Well, first, in terms of the situation in household imbalances, there are conflicting signals or mixed signals, different developments. You referenced the StatsCan data. On the margin, that paints a picture of a slightly more vulnerable household sector. Not all of the adjustment, some of the adjustment is technical, but on the margin, it does show a slightly more vulnerable household sector. At the same time, the rate of growth of household debt has slowed, as you know, to about 5.5%. And we expect it to slow further over the course of the projection horizon, and ultimately that debt level to stabilize by, by the end of the projection horizon. There are signs of softening in the housing market. We see that in resales, for example, and some valuation adjustments. And so but at the same time, on the upside, housing starts remain above demographic demand or household formation, said a different way. So there are mixed signals. As you know, the government has taken steps on 4 different occasions to tighten mortgage insurance rules. We think those measures are having an impact, and in conjunction with the measures that have been taken by OSFI, pardon me, and we, along with other federal authorities, are watching the situation closely, monitoring the situation closely. The last point I'll make is that what we've tried to be clear about, not just in this monetary policy report, but in prior communication speeches and in fact in our inflation control renewal document at the end of last year, is that monetary policy, if it has a role to address these issues, is the last line of defense. So it's after taking in all other aspects and all other measures that could be taken into account.
I have a separate question. It's about the components of growth that was in the report. Talked about consumption and business investment still the main drivers of growth, but we had data yesterday that showed softening in retail sales. And as far as business investment goes, you have decisions like the Petronas Progress deal that the government rejected that. I mean, isn't that going to isn't that just going to put off a foreign investment in the oil patch, which is much needed?
Well, I'm not going to speak to the specific transaction, but in terms of the overall profile for business investment in the report, we would characterize it as solid business growth, or investment growth rather. It is slightly less rapid than it was than we had projected in July. We think that's a product of some of the global uncertainty that is out there. We have taken that into account. We've also made a slight adjustment for some of the revisions that have been shown in the national accounts, which leave us with a higher capital stock than previously had been reported. So we make an adjustment for that. But we're seeing over the course of the projection, our view is that we'll see investment growth in mid-5s, 6% type annual growth in investment. So that is solid. That obviously reflects very favorable financial conditions and ongoing competitiveness imperatives. With respect to consumption growth is moderate over the horizon. And it's not running. Disposable income growth will be running probably around 4%, and we have consumption growth in the area of about 2%. So there is some adjustment there, which reflects, in part, we think, the somewhat strained position of some Canadian households given the debt burden.
Louise Egan, Reuters.
Hi. You've always said that monetary policy is the last line of defense in the household debt problem, dealing with the household debt problem. So you've talked about it a lot. The government has come out and done measures and is suggesting that it was, this recent move was its last one of that kind. So are you sort of signaling that the ball is now in the Bank of Canada's court? The next move would have to be sort of a monetary policy move to curb household debt?
Well, I think the first thing is that the measures that the government has taken have been both prudent and timely. The cumulative effect of those measures has not fully been felt. So we, with others, are monitoring the impact of those steps. The second is that there are other tools, and one example would be the underwriting guidelines, the new underwriting guidelines for mortgages and HELOCs that OSFI put in place, which are also just taking effect right now. The third, obviously, and the first line of defense, actually, but my third point, to confuse things, is communication around the issue. So, look, monetary policy can play a complementary role. It's not the first mover in any of this. I would emphasize that our view on the risks in the household sector writ large, that those risks are very much to both sides, given the stretched position in both the housing market and in some household balance sheets, and we're monitoring the situation closely, and we'll adjust.
I've noticed that there seems to be more emphasis on this fact that the risks are on both sides. It seems like it was there before.
It was certainly there before, yes. Yeah.
I don't know. Is there a reason for emphasizing that there are risks on both sides this time?
Well, if you go back to the July report, for example, the risks were on both sides on the housing sector. So now we've seen developments in both directions. What we've tried to be clear about, though, here and in other communications, is that if monetary policy has to play a role, that's a conditional statement, then we will be very clear about the use of monetary policy in that role. So there's no sort of stealth, there's no acting by stealth here. And that is entirely consistent with the flexible inflation targeting regime that the bank operates under, that is detailed in excruciating detail in the Inflation Control Renewal Agreement.
Les Withington, Toronto Star.
When you say you would make it clear that you were using monetary policy with regard to the household debt issues, does that mean you would make it clear in advance, or you would make it clear when you actually did it?
Well, I think it means both, Les. It's clear from a framework perspective in terms of the potential role. Obviously, if I mean, this is an extreme example, but if it ever were used in that regard, one would expect that there would be some adjustment to the horizon over which inflation returned to target, either from above or below, and that adjustment in the horizon would be clearly explained. But we would. I mean, I think we are being clear. Right now, in terms of the overall approach, we are all dealing in the hypothetical at this stage, and I would reemphasize that a number of measures have been taken. They are having an impact. There are adjustments that are underway in the household sector and in the housing market. We're watching them closely, as others are, there is a potential complementary role of monetary policy, and all we're doing is making that point clear.
And would you do that under the rubric of inflation targeting,
yes,
or financial stability?
We do it. It's under the rubric of of flexible inflation targeting, first and foremost. And what would happen would be there would be an adjustment, likely, an adjustment to the timeline over which inflation returned to target. Now, I should say as well that in history of inflation targeting, the 20-year history of inflation targeting, we've had inflation returning to target, and expectation it would return to target in as short as 4 quarters and as long as 10 quarters in our projections. So depending on the circumstances, the headwinds, tailwinds in the economy, there is an optimal path to return, and what we try to do, what we do is make it very clear that the path we expect to follow. But I think the last point I would make on it is just reinforce that, these financial stability risks, if the big financial stability risks are realized, they will have consequences over the medium and longer term for the path of activity and inflation in Canada, which is why the government has taken 4 timely and prudent steps, which is why OSFI has tightened underwriting guidance, which is why one of the reasons why Canadian banks are moving to Basel III 2019 definitions of capital at the start of next year. And all those factors influence the evolution of this. All of them are having an impact. And we, well, I'll leave it there. I think I've covered it.
Okay. Gordon Isfeld, Financial Post.
Governor, in the quest for clarity, what would be the pros and cons of the Bank of Canada adopting a Fed-style guidance? They're already into mid-2015 for low rates.
For the Fed. In the deliverance of clarity, we have a framework on unconventional monetary policy, which we published in April of 2009 with the Associated Monetary Policy Report. Our view is that form of guidance, a conditional commitment, which is, by the way, the term used to describe in the U.S., which is a term that was coined by the Bank of Canada to describe what we did in April of 2009, that is from our perspective, that is unconventional policy. That is the type of policy one uses when conventional modes of policy are exhausted, and so that it was an instrument that we did use to, in our view, to good effect, and actually independent researchers have found similar results. Michael Woodford from at Jackson Hole, his paper goes through this in some detail, actually. But that's following the exhaustion of conventional monetary policy, which effectively is movements in the overnight rate.
Everything else is exhausted. Is it still an option?
As per our framework for unconventional policy, it is, yes.
Greg Quinn, Bloomberg.
There's been a lot of headlines in the last little while about foreign investment in Canada. There's a political debate, but are there any economic reasons why Canada should reject investments from communist countries, from state-owned corporations? Is there any difference economically in the types of foreign investments that Canada might be looking at over the next couple of years?
I'm astonished that you think I would answer that question. The government has signaled that it will be making decisions and announcements around our foreign investment regime in the relatively near future, and that's the responsibility of the government. And like other Canadians, we look forward to those decisions. So, let me make a general point, which is Canada is an attractive destination for foreign investment. And in the most general sense, in an uncertain world, in a world where many advanced economies have real challenges with, on the fiscal side, challenges in terms of, which are being met, I must say, on the central banking side, but real challenges in terms of the need to pursue unconventional monetary policy in very large size, challenges in their financial sector. That Canada is an attractive investment destination, and our challenge is how we use that capital which comes into Canada and how we channel it most productively. So I wouldn't overplay the investment story.
Can you update us on what's happening on the CDOR rate, given what's happening with LIBOR? It's not heavily regulated now. Given the concerns about the LIBOR rate, does Canada need to consider new regulations? Are you seeing signs that there's a thorough investigation going on to how it's being used.
Well, a couple of things. One, IROC is conducting a review of CDOR, and we look forward to, and the Bank of Canada is participating in that review. It's a review with market participants, other interested stakeholders. We look forward to the results of that review. I would note that CDOR, unlike LIBOR, had been regularly reviewed over the course of the last decade. There's an oversight council that exists. There had been a number of changes over the course of the last little more than a decade, actually, which had improved the functioning of CDOR. And then more broadly, there is a review of most reference rates, not just interest reference rates, but also including commodity reference and other reference rates, that is being conducted. Several reviews. One is being conducted by IOSCO, the International Association of Securities Commissions. That will feed into an FSB process, which also will get informed by a review that's being done by the major central banks. Bank of Canada is participating in that. We obviously have national level reviews, not just the CDOR review, but the Wheatley report in the UK on LIBOR. So all of this will, I think, work towards better principles in terms of how to manage or how to conduct these reference rates, better market conduct rules for the implementation of these, better governance arrangements in the development of these reference rates. And probably over time, I would expect that, and these are decisions for market participants, adjustment in terms of the reference rates that participants use and how they use them.
Julian Beltram, Canadian Press.
Again, in the interest of clarity, you changed the guidance on the future interest rates policy yesterday. There has been some, debate in among economists exactly what you were, what you did. If the previous guidance was moderately tightening bias, what is the current?
You want us to write we can write your story if you want, Julian. That would be any help. The case for adjustment of interest rates has become less imminent, but it is important to recognize for both Canadians and then the subset of Canadians who are market participants and then broader global market participants that given the fact that the Canadian economy is operating with a very small output gap, given that we are in an expansion, not a recovery, which is relatively unique in advanced economies, and given our outlook for, albeit moderate global growth, but the implications of that for our terms of trade and the outlook for Canadian growth, and including in all of this the potential evolution of imbalances in the household sector, that over time rates are more likely to go up than not. There you go.
Again, this is not really a.
But I think if to draw more precision out of it than that is false precision at this stage, because there's a number of factors. The world's a big uncertain place. There's lots of volatility there. We discussed at some length the situation in the household sector, which, as I say, has some mixed signals on where the adjustment is going, and there's always events in economies, and we're going to adjust accordingly.
Yeah. So, speaking of events since July, my impression in this monetary policy review is that you're a little more optimistic, especially involving risks, than you were last July or in July, even though the numbers overall haven't changed very much.
I would say that, for example, in terms of containment of the crisis in Europe, the measures taken by particularly the European Central Bank with the OMT program, some other measures taken by European authorities have reinforced the probability that the crisis will be contained. Obviously, containment, as we've emphasized many times, is a relatively low bar. That's different than resolving the crisis or ultimately refounding European monetary union. There's a lot that remains to be done there. The second thing I would say is that the aggressive policy response of, amongst others, the Federal Reserve is relevant to the outlook for the United States. Further, we see some signs. We had expected, I underline this, we had expected a relatively marked slowdown in China. The question was where growth was going to stabilize, at what level growth was going to stabilize. I don't want to overplay it, but there are some signs of growth stabilizing at these levels. And then we continue to see in the United States, and I'm speaking globally around the big global risks, we continue to see signs of recovery in the U.S. housing market. So to wrap all of that together, so those risks in the near term have reduced, those global risks, and you'll note that I have left one out, and I'll come back to the fiscal cliff in a second. Those global risks have reduced, and our outlook for foreign activity, which is detailed in the report, in other words, the components of global growth that matter the most for Canada, is quite strong, and we have not given the Canadian economy, particularly the export sector, all the benefit of that because of our competitiveness problems. Now, just briefly on the fiscal cliff, look, we're no wiser on the fiscal cliff than anybody else. The real negotiation discussion of this will start after the U.S. election. It is a major issue. If mishandled, the U.S. will be pushed back into recession. I think the parties know that. But the actual path to resolving this issue, or potentially delaying this issue, which also would have economic consequences, is not clear. So we have a very transparent assumption about where we see fiscal tightening in the United States next year, 1.5%, 1.5% the year following. But we, like you, will find out when American authorities take their decisions.
Cormac McSweeney, Rogers Radio.
Just want to go back to household debt for a minute. In your report, you say that there could be a deceleration of household spending, and relatedly, if there were a sudden weakening in Canadian housing sector, it could have a sizable spillover effect on other areas of the economy due to household debt. I'm just wondering, do you think we're at a tipping point where, the slightest thing that changes in the housing market could have a major impact on the economy because of the debt levels Canadians are at right now?
We don't. We don't think that. That's certainly not our base case. Our expectation is exactly what you said, which is that there will be this adjustment, gradual adjustment in the pace of accumulation of household debt. That's one of the things that impact both the level of activity in the housing market and consumer expenditure, and that this adjustment will proceed in part because of the measures that have been taken. That is our base case. Now, there is obviously a risk that the adjustment could be more severe. We've outlined clearly that is a risk, but that is not our expectation. That's not what we expect to happen.
And you've been warning for a long time now that household debt is just getting way too high. Do you think Canadians are starting to get that hint and actually starting to take care of their debt levels?
I think there are signs that is happening, and they are welcome. But we're not here to be complacent. As your central bank, we're here to focus on what could happen and what can be done about it to reduce the possibility of more severe outcomes.
Unless there are any further questions. Okay, I have 1 minute, so you raised your hand first, I think, Nirmala, but...
Governor, there's a perception about transparency at the bank with regards to your speech last Monday. Markets and analysts were expecting something else. You said you'd be transparent about communication, and you left out that phrase that signal potential rate hikes, and markets took that to mean that
some in the market
was stepping back from that hawkish bias, but that didn't turn out to be the case in the rate statement.
Is there a question here?
Yeah, so the perception is that you didn't follow through on that promise of transparency in terms of communication.
Well, the perception's incorrect. I mean, we changed our forward-looking statement. We changed our guidance. I left out the old guidance in the speech, in the context of a speech which was about the global economy, largely about the global economy, and making, with respect to the Canadian economy and monetary policy, this basic point, which we have been discussing this morning, which is the role of monetary policy and with respect to household imbalances and financial stability, and the fact that we will be clear about any role that monetary policy is playing. Now, we have been clear. We've had a detailed discussion of it here today. There's a detailed analysis of it in there. All of that is entirely consistent with what we have been talking about, to Cormac's question, what we've been talking about over the course of the last several years and the developments in household debt. And so full stop. We have our decision. We have the view. We'll see how the economy unfolds, and it is what it is.
I don't know, Les, if we have 1 minute to squeeze you in.
That wasn't it.
Do we?
Oh, we'll have a minute, okay. For
Les
Les.
Livingston, really quick, please.
I'm just wondering about the household debt. Do you find the bank is in a bit of a, or policymakers are in a bit of a bind here, because you have to keep, there's a feeling you have to keep interest rates low to try and help the economy due to the world situation, yet it inevitably encourages Canadians to take on more debt. So, I mean, how do you...
Well, without question, it's a challenge. I mean, because of global headwinds, there is a need to provide very stimulative monetary policy in Canada to encourage business investment, to encourage and to encourage household borrowing for those households who can afford to borrow and afford to borrow over the long cycle of interest rates, and also to take into account global pressures, including pressures on the exchange rate. So there's a variety of reasons to ensure that we're providing very stimulative monetary policy to Canada and to Canadians, and that's what we have been doing. One of the consequences of that are these risks around household debt. And the question is, and the first best response, rather, to that is to use other instruments in order to ensure that a subset of Canadians does not take the current situation and get themselves overextended and effectively into trouble in the fullness of time. So first, we try to be clear about the likely path of interest rate, as clear as we possibly can be in this global environment. That's the first point. Secondly, we also try to be clear in communications in terms of the risks that are entailed, and we have done that extensively, and I think with your help to some effect. Thirdly, other authorities independently take decisions, but informed by discussions, obviously. They independently take decisions on measures to help ensure that there's a sustainable path to the evolution of household finances. OSFI, the Government of Canada, they have taken those steps. And that's the best way to manage this, because the reason one doesn't want to lead with monetary policy in this situation is that it has consequences for the entire economy if we were to tighten only to address one aspect. But we have to be conscious that monetary policy needs to play a supporting role to these other efforts, particularly if they're not fully successful.
Okay, this does conclude our press
conclude.
conference.
Yes.
Thank you very much.
Thank you very much.
Sorry.
Yeah, that's all right. Thank you.
Thank you.
All right, take care.
Bye.